So, you've probably heard that you should make your money work for you, right? But if you've ever felt totally overwhelmed by the stock market, you're in exactly the right place. Today, we're going to demystify one of the most popular ways to get started: the mutual fund. Does this question hit home? You know you want to invest, you know you want your money to grow, but actually figuring out that first step, well, it can feel like you're about to jump off a cliff into the great unknown. And listen, if that's you, you are definitely not alone. I mean, trying to pick individual companies, researching stocks, deciding when to buy and when to sell, honestly, it's like a full-time job, and it is seriously tough stuff. But what if there was a simpler way to do all this? Well, there is, and that's exactly why we're here. Let's talk about the solution: the mutual fund. Okay, so what in the world is a mutual fund? Just think of it like this. It's a giant pool of money. It takes cash from thousands of investors, people just like you and me, and then a professional manager uses all that money to buy a whole bunch of different investments, like stocks and bonds. This is maybe the easiest way to get it. Instead of going to the grocery store and trying to pick out every single perfect fruit and vegetable one by one, you're just buying a pre-made basket that an expert already put together for you. It's that simple. And doing it that way gives you three huge benefits right off the bat. First, instant diversification. That just means your money isn't all in one place. It's spread out, which is way less risky. Second, you've got a professional making the calls. And third, they're super accessible. You don't need to be rich to start. And just to show you how normal this is, check this out. In 2024, more than half of all households in America, 56%, owned mutual funds. So this isn't some weird, complicated thing for experts. It's a core part of how people build wealth. All right, so you get the idea. But there are literally thousands of different funds out there. So how do you find the right one for you? Let's talk about the main flavors you'll run into. It pretty much boils down to these three main types. If you're looking for your money to grow over the long haul, and you're okay with some ups and downs, you'd look at an equity or stock fund. If you'd rather have more stability and just get some regular income, a bond fund is your best bet. And if you kind of want a little of both, well, that's what a balanced fund is for. And here's a peek at what that balanced approach usually looks like. A really common mix is something like 60% in stocks for growth and 40% in bonds to act as a stabilizer. It's all designed to give you a much smoother ride. Now, besides those main three, there are two other super popular types you'll see. First, you've got index funds. These are simple, they don't try to beat the market, they just try to match a market index like the S&P 500. They're usually very low cost. Then there are target date funds. You see these a lot in 401ks. You just pick the year you want to retire, and the fund automatically gets safer and more conservative as you get closer to that date. It's a real set it and forget it option. Okay, that's enough of the what. Let's switch gears and talk about the how. How do you actually go from knowing this stuff to owning your first mutual fund? Let's build your action plan. We can break this down into three simple, manageable steps. That's it. Step one, figure out why you're investing. Is this for retirement in 30 years or a house down payment in 5? Step two, you open an investment account. And finally, step three, you do a little homework and pick your fund. And when you get to that third step, you have to check the label on the fund. First, look at the expense ratio. That's the yearly fee. You want this to be as low as possible. Then check for loads. Those are sales fees. The goal is to find no load funds. And last, look at the minimum investment. The great news is tons of funds today have no minimum at all. All right, let's head into our final section. Because, being a smart investor isn't just about spotting the good stuff. It's also about understanding the risks involved. This is the number one rule, and let's be super clear about it. Investing is not the same as saving. Your fund owns things that go up and down in value. So when the stock market has a bad year, the value of your fund is probably going to go down too. That's the trade-off for getting that potential for higher growth over time. Now, here's a risk that can be a little sneaky: fees. This chart shows something called fee drag. So let's say the investments in your fund earned 9% in a year. Nice. But if the fund's fee, its expense ratio, is 1%, then your actual return is only 8%. Now, that might not sound like a big deal, but over 30 years, that tiny 1% difference could eat up almost a third of your potential earnings. It's a huge deal. And those fees are often tied to how the fund is managed. You've got actively managed funds where a manager is trying to pick winning stocks and beat the market. That costs more, so the fees are higher. On the other side, you have passively managed funds, like those index funds we talked about, that just aim to match the market. It's a simpler strategy, and that usually means much, much lower fees for you. So here's the takeaway. Your money has the potential to be out there working just as hard for you as you work for it. And often, the biggest thing stopping us is just taking that very first step. So now that you know all this, what's your first step going to be?